The shakeout we'll really see in the next 3 to 6 months. Right now, SVB is probably one of the safest banks on the planet to bank with. They've got all their deposits are guaranteed.
In today's video, we're going to take a look back at Silicon Valley Bank. We're also going to take a look at what was being said by the media back then and compare to where we are today. Now, in this first segment, you heard the person in the media say that Silicon Valley Bank is essentially one of the safest banks in the country and that all deposits there are secure. That was not the case when the crisis first started there, as many of the accounts there were outside of the FDIC insurance limits. Because of the great financial crisis back in 2008, legislation was passed to prevent having to bail out the banks. But apparently in this situation, the feds basically had no choice but to step in and make a statement saying that all the deposits there are safe and secure. What you have to understand is that with the Western financial system, it really is about a game of confidence. And if that confidence is lost, that means that the entire banking system could potentially collapse. So, I just given you an explanation as to why they had to step in. Now, we're going to also look at how events are happening right now and how that could potentially impact the commercial real estate market in the near future. There's a lot being said here, so let's get into this.
I think one of the things that's really important to talk about, though, is that these regional banks, these banks that specialize in certain industries, are very important for the base of the U.S. economy, which is understanding their customers. And so the hope is that once this shakes out, that these banks that cater to startups and entrepreneurs across the country will be there. And ideally, there'll be more than one. Because one of the things that we did learn is having diversity, having multiple banks for these startups to call upon would be great.
And so for some of these startups who are wondering, should they just sort of gravitate towards some of these big banks or perhaps go to angel investing or something else, what would you tell the startup community about this period that we're in right now? Because obviously, as you said, it's still expecting some of these ramifications to last for at least some foreseeable months.
Well, just to clarify, angel investors and banks are very different. The banks weren't, Silicon Valley Bank wasn't, traditionally the primary investor in a lot of these companies. They were the banking partner. They held their deposits. Sometimes they lent them money, but they weren't the investors for the most part. They were the primary investors. So angel investors isn't an option. I think that what we've always told our companies and what we told our companies in the heat of the moment was that regardless of the situation, you always want to have 3 months liquidity minimum at multiple banking institutions, just in case the unthinkable happens. And the unthinkable happened in the last 10 days. So that's been our advice. So whether it's regional banks or some of the larger banks, I think you want to have diversity in your asset holdings. And I think that's the answer that you want.
So once again, game is being exposed as we're being told just how important small and regional banks are to the U.S. economy. In the situation with Silicon Valley Bank, turns out they were the primary lender to the startup companies in Silicon Valley. Now, if we look at just how important small and regional banks are to the bedrock of the economy, when you look across the country, if something goes bad, it can go really bad. So we're being told that for small and medium businesses that they should diversify their assets across multiple banks. But if you're a company, that doesn't really work for you if you have hundreds of millions of dollars, because the FDIC insurance limits are very low. So that brings us to what we're seeing today. A lot of small and medium-sized businesses are taking their money out of the smaller and regional-sized banks and putting their money with the big banks and depositing funds into money market accounts that have higher insurance limits. This is leaving holes in balance sheets the size of Texas. And so the question is what do these banks do in this situation, right? So let's continue.
This bank was considered sort of the firewall to that contagion that happened last month with SVB and their collapse, and which is why all these other banks have poured billions of dollars in there to try to prevent that contagion. What we saw today was really how dire the situation was for First Republic.
So First Republic Bank was supposed to be the bank that acts as a firewall to prevent the crisis from spreading. Other banks had to step in and provide liquidity to this bank, but we're about to find out just how well this plan is working.
You mentioned the $100 billion in deposit drain. That's what it would have been without the $30 billion injected from J.P. Morgan Chase and others. So that was that was pretty bad on its own, because that's not dissimilar from the scope of bank runs at SVB, at Signature Bank. The update they gave today is it seems to have stabilized. They've only lost 1.7% of their deposits in the last 3 weeks, which sounds like good news. I think the bad news is they're attempting to drastically shrink the business. They're talking about cutting up to a quarter of their employees. They're talking about cutting their office space and drastically cutting back on their loan book.
Well, the situation for First Republic Bank is not looking good. Currently in the ICU on life support, sucking up cash from the Fed, trying to stay afloat. They have a huge hole in their balance sheet. They're losing money left and right. And they're trying to figure out how to stay afloat because they have to be able to raise capital to stay solvent. So they're talking about laying off people, getting rid of office space. They're trying to do everything they can, to stay afloat in the hopes that they don't have to file bankruptcy. So we know that they're getting help from the Federal Reserve, but the question is, will that be enough?
And finally, one thing that you have to talk about is, the CEO, Mark Ruffler, ended this really abbreviated 12-minute call, no Q&A. He ended it with the idea that they're still looking for strategic options here, which is Wall Street speak, as you know, we're looking either for a capital raise or we're looking to sell the place.
I mean, you got to repeat what you just said. Their earnings call, arguably the most important earnings call in this company's history. I don't think that's 40-year history. There's no way that that's not accurate to say that. They not only didn't take any questions. You said the thing was over and done in 12 minutes.
Done and dusted in 12 minutes.
No questions.
No Q&A.
That's probably why the stock is down.
So things aren't really looking good for Silicon Valley Bank. I don't know what their options are at this point. So they have a giant hole in their balance sheet. They're in the ICU on life support from the Federal Reserve, right? What can they really do? So they're trying to cut expenses. They're trying to get rid of employees. They're trying to get rid of real estate. The reason why the stock is down so much is because they can either A, sell bonds at a very high interest rate. That doesn't seem like a feasible option. Who would buy them? Or they can issue more shares of the company, basically diluting the stock price, hosing investors. And so the question is will this firewall completely break down? And if it does, what happens after that?
I think
it's not the deposits. People I didn't get any answers.
It doesn't show a lot of confidence. Here's another key tidbit from the call, which is part of their problem clearly is that they've lost so many in deposits, right? That's obvious. Everybody wants to hear about deposits. What that meant is basically, they've replaced some of that money with high cost, borrowings from the Fed facilities. So you're losing this, this super cheap source of funding. You're replacing it with 5% funding from the Fed facilities, and that's really going to pressure their business going forward.
Sorry to type, but let's bring that chart back up because the stock was down about 7% earlier in the session. If you're listening on the radio, First Republic is now down 23% in the extended hour. I'm looking at my CNBC chart here, so forgive me. Don't show me on camera. I believe that would be another new multi-year or all-time low for the stock. If not, it's certainly darn close. They just lost another quarter of their value after hours.
Yeah, the overall picture here is, most companies that are down 90% are in some kind of existential issue here. One new thing that I'd like to add is, and perhaps there's a note of skepticism out there. They talked about, look, we need to bring in new customers. We need to convince businesses and nonprofits and retail people to bring new deposits into this company. But how realistic is that? If you're a business owner, are you going to go to First Republic? Brian, there are 4,100 banks in this country, and this is the one you're going to choose. So that's sort of some of the questions out of this call.
As I stated earlier, the United States financial system is a game of confidence. There's really nothing backing it but a bunch of debt in the U.S. military. So once confidence has been lost in you as an institution, there really is no hope. I really do believe that First Republic Bank is living on borrowed time, and at some point, the government is going to have to step in and take over. The question is what message does that send if they have to do that? Or will they try some type of trickeration move and have another bank buy them out so that they can try and save face and keep confidence alive in the banking system for the time being? But make no mistake, the situation is getting worse. Credit is tightening. Citibank, for example, is not floating cash to dealerships to float their fleet that they're trying to sell. So you have commercial lending where developers are trying to get cash and, they're not able to get money from banks. So as credit tightens and less credit is available, this is going to have a significant impact on the economy, and it's a cycle that will feed on itself and drag us down. So this is getting very interesting.
First Republic shares plunging off just about 15% following its latest earnings release. Now the bank detailing that deposits were down nearly 41% in the first 3 months of the year. That's down from the prior quarter. Here to break it all down, we want to bring in Jason Benowitz. He's CI Roosevelt Associate Partner and Senior Portfolio Manager. Jason, it's good to see you here. So certainly the street taking issue with the fact that we did see deposits drop 40% quarter over quarter. What's your first take at these results?
Yes, so you highlighted what I think is the most important takeaway from the results, which is that First Republic deposits declined. We were all expecting a decline, of course, but it was more than we expected. So, sort of a baseline expectation headed into this quarter was perhaps that, there was a report on March 19th that First Republic had lost $40 billion in deposits, but then, $70 billion. But we also know that they received $30 billion from the consortium of 11 banks and sort of a private sector rescue. And so the net of that, we would have thought that the deposits would not have fallen by the $100 billion that was reported today.
So the situation for First Republic Bank is not looking all that great. $100 billion is a lot of money. And to think that this is one bank out of more than 4,000. How many other banks are facing similar challenges, and how many of them are going to the Fed to trade trash for cash? Like I said, they have to be able to raise capital to stay solvent as they run into trouble and deposits flee from one system to go into another. It's a fundamental change in the banking system as we know it happening right before our eyes, and it's not going to go back to what it once was.
Okay, so from their CFO, Neil Holland, we moved swiftly and leveraged our high-quality loan and securities portfolios to secure additional liquidity, adding we are working to restructure our balance sheet and reduce our expenses and short-term borrowings. How would you characterize their health, and what do they need to do moving forward?
Right. So because they lost so much in deposits, they have to replace that funding somehow. And so they're doing it with borrowing. But the problem is that deposits are a low-cost source of funding, whereas borrowing is a higher cost, and it really is going to weigh on their profitability, both in the reported quarter as well as going forward. So this isn't really a strength of theirs. Now, what they're talking about is, they have to fix that somehow. They have to find, new deposits to somehow sort of lower their total cost of funding and repay some of those borrowings.
So we know that First Republic Bank is getting help from the Fed. They're trading assets that are worth less than what they paid for them and paying interest in order to raise capital to keep the bank solvent. Now, the funny part is that they have to try and find deposits. And that's going to be hard given the fact that the news is basically telling everyone that capital is leaving the bank. Like I said, the banking system is going under a fundamental change. Small and medium-sized businesses that have more than $250,000 are not safe putting their money in these small and regional banks. So good luck in trying to find deposits. I don't think that's going to work.
But, I continue to wonder how they're going to be able to do that. So this is another concern that sort of flows from the fact that the deposit outflow is worse than expected.
Jason, how hard is it to get a full picture on the stability of this bank right now? Because the company also withdrew all of its prior guidance. They're not taking any questions on the earnings call. So how do you look at that from an investor perspective?
I mean, I'm not really surprised that they're not giving guidance because things are so uncertain. I really wouldn't have expected them to. So that's not really necessarily a disappointment. But what you highlight is, the stock continues to be very volatile. And the reason is that the future of this company is very uncertain. So, there's
some potential that they can sort of right the ship and, shrink to the point where they are sort of profitable on the business that they've retained. And then there's some value, perhaps even greater than book value going forward, if you assume that kind of rebound. But on the other hand, it's going to be very difficult for them to do that because their cost of funding is so high. They're no longer an investment grade bank, which is a real challenge in this industry. And so, they continue to, at the same time that they are operating the bank, they're looking at their strategic alternatives and who might they be able to partner with and sort of get a rescue from. And all of this is ongoing. There's many different ways it can go. And that's why as investors sort of change what they think the probability is of these different scenarios, the stock moves so violently as perhaps we're seeing after hours today.
Jason, the Fed whisperer, as we call him, Nick Timiraos, writes in the Wall Street Journal over the weekend why the banking crisis isn't over yet. He's citing the former Dallas Fed president, Robert Kaplan. How do you think this banking crisis will continue to play out in the quarters ahead?
I think what perhaps, Timiraos and Kaplan were referring to is the next phase of the crisis could have to do with commercial real estate. And we know that banks lend to commercial real estate. They're an important source of funding for that market. And so if we were to see sort of banks pull back, it's not clear who would step up and there could be defaults. And so and there have begun to be some already. For example, Brookfield, the real estate investor, has defaulted on some loans. And so this is an area where, perhaps it could, again, make investors nervous and reignite the crisis. But so far, things have stabilized from where they were in early March. And there's no, this is more of a long-term thing that could play out over quarters rather than something that's imminent.
Yeah, Jason, talk a little bit more just about those broader implications just in terms of what we're seeing play out in commercial real estate. I guess how bad could it potentially get?
So we know the timeline for the commercial real estate problem is really around 2025, where there's $1.5 trillion worth of loans coming to maturity that have to be refinanced. And we know what the situation is looking like there, right? They're highlighting that these banks are indeed involved in the commercial real estate market, right? And so we know that this bank can't be the only bank that's in trouble. This is just the only bank that you're hearing about. I'm pretty sure there are many banks out there that are in trouble. Okay, so as credit continues to freeze up, banks are not, generating loans, which means they're not generating profits. They're laying people off, right? And as their deposits leave, they have to raise capital, which means they have to liquidate assets to do so, right? And so all of this is a heavy drag on the economy. It's going to be a heavy weight in the markets, but because the time frame is so far out, it's not in the very near term, it's in 2025, you're not going to see the impact right away. But that doesn't mean that you shouldn't get prepared. Now's the time to gather as much information as you can so that you can take advantage of whatever opportunities come out of this. But clearly, we know the situation is really bad. We already seen a couple bankruptcies happen already that's in the hundreds of millions of dollars. Okay, that's just a drop in the bucket. So as this crisis deepens and we start hearing more and more, as I'm sure, stories will come out here and there, and then it will start to accelerate, then we'll see just how bad things are really going to get.
Right. So, commercial real estate, obviously it's a major market. And what's unique about it is that these regional banks are typically the ones that, fund it more so than other markets. And so they have a meaningful presence there. And then the bank crisis, what it's done is it's taken these, these regional banks and it's said to them, your funding costs are going to be higher in the future. There's likely to be more regulation coming down the road. And it's likely to sort of have them kind of rein in their activity broadly, but it will be most impactful in this sector. And then you can layer on top of that, if you just think about within commercial real estate, the office market, where vacancies are lower because of remote work trends. There's been a lot of construction in recent years. That's sort of vulnerable anyway. And all those things, these are the areas where the banks that are most exposed to those could be most impacted. Now, that's not First Republic. So in essence, First Republic shouldn't be so shaken by this type of activity unless, other banks were to become wobbly and then it might spill over in sort of a chain reaction.
So in conclusion, the message seems to be pretty clear that banks are very interconnected with one another. So what can happen to one bank can impact another. So definitely we will have to look at how all these loans are insured and what type of default swaps they have and who's actually holding them. Because if an insurance company goes down, that can also have a very severe impact on the economy, right? Which creates opportunity somewhere. So I hope you liked the video. If you did, please like and subscribe, and I'll catch you on the next one.